Stocks have done so well this year that it's fair to say market participants haven't feared much. But just because risks haven't affected markets lately doesn't mean they won't in the future. As Halloween approaches, we discuss what scares us about the economy and financial markets. Let's start with consumer spending trends. For U.S. consumers, it's the best of times and the worst of times. It's no surprise that upper-income households supported consumer spending in recent periods. And it's also no surprise that firms like credit card lender Capital One want to focus on the wealthier consumer, knowing those consumers weather downturns better. When people talk about a resilient consumer, what they are really talking about is upper-income households. To borrow from Charles Dickens, the current macro landscape is the best of times and simultaneously the worst of times. What scares us this Halloween season is the potential stress on the wealthier cohort, as more upper-income households reported they will most likely be unable to make their minimum debt payment, now at the highest percentage since mid-2014, when the economy was feeling the after-effects of the global financial crisis. What about the growing mountain of federal debt? One of the largest risks to fixed income markets remains the amount of Treasury debt needed to fill massive federal budget deficits. Regardless of who ultimately becomes our 47th president or the makeup of Congress, the biggest loser could be the fiscal deficit. Per the Congressional Budget Office, the U.S. government is expected to run sizable deficits over the next decade to the tune of 5 to 7% of gross domestic product each year. The deficit is on track to increase significantly in relation to GDP over the next 30 years, reaching 8.5% of GDP in 2054. In early October, total outstanding Treasury debt eclipsed $35 trillion, which is up from the $31.5 trillion in June 2023, right before Congress gave the Treasury Department unfettered borrowing capacity until January 2025. Now, to be fair, only around $28 trillion of that is held by the public, with the rest held within the U.S. government. Despite the mountain of debt and growing interest payments, the U.S. government is not at risk of financial collapse, nor are there concerns as such. However, regardless of leadership in Washington, the deficit will stay high for years to come, and it will probably take market volatility for politicians to take the deficit seriously, similar to what took place in the UK in 2022 or France in 2024. That creates downside risk for the economy and investment portfolios. Then we have the rich stock valuations. On a simple price-to-earnings ratio basis, using estimated next 4 quarters earnings per share, the S&P 500 is currently selling for 21.8 times. That compares to the 20-year average at 16. Even using the higher, more recent valuation levels, the 5-year average is 19.8. Clearly, valuations are high, though they are not great timing tools for tactical trading. High valuations are worrisome because once the economy and corporate profits deteriorate, for whatever reason, market declines will be larger if valuations are higher. Further, studies show that long-term stock returns, say 5 to 10 years out, tend to be more modest if the starting point for valuations is high. The scary point here is that the more a market inflates during good times, the bigger downside moves tend to be once the good times end. Another issue for concern is that interest rates are going up again. LPL Research expects 10-year Treasury yields to remain range-bound between 3.75–4.25% over the coming months. However, that doesn't mean a surge in rates is off the table, especially amid improving economic data and a recent uptick in inflation expectations. Higher rates can hurt the economy, the equity market, and bond prices. Higher borrowing costs impair demand for big-ticket purchases. Higher yields tend to weigh on stock valuations and increase the cost of capital, especially for the more debt-laden small-cap space. And of course, higher rates drag down bond values. How about the election? With Election Day only a few days away, policy uncertainty ahead of the election may not cause a stock market correction. If one occurs in the coming weeks, it could be related to concerns about tax increases in 2026, when the Trump tax cuts sunset. This risk is known and far off, but could still cause market volatility. Also consider the possibility of another disputed outcome, a very long wait for results, or intensifying political divisiveness as risks to investor sentiment. Having gone through the hanging chads of the Bush versus Gore election in 2000, various swing state recounts, and the January 6th experience in 2021, perhaps markets are battle-tested for election chaos. We can also take some comfort in history's lesson that stocks tend to rally after elections, regardless of the outcome. But as the country gets more divided, investors' moods could be negatively impacted and weigh on stock valuations. As Halloween approaches, there are several risks that scare us and may lead to increased market volatility in the months and years ahead. But these risks don't prevent us from recommending investors to stay fully invested at their targets for both equities and fixed income. We're still in a bull market with a growing economy, rising corporate profits, and a favorable technical analysis picture. Valuations are elevated, but are not good timing tools. And while the deficit is worrisome, the timing of when it will become enough of a concern to drive sustained weakness for stocks or bonds is uncertain. Finally, policy uncertainty and political divisiveness may lead to higher volatility, but history tells us that those episodes tend to be short-lived. The resilience of the U.S. economy and corporate America will win in the end.